Alright, hey, what's up, guys? Currently trying to finish my write ups for. Okay, so I'm about to start these write ups. Just trying to update my Diddly Wiki right now. But I'm very close to finishing. I just need to get the readings back on my computer. Call phone, okay. Alright, nice. Logged in. Looking for the articles and the assignment description again, just so I can make sure I have everything before I turn it in. So let's see. Files. Alright. Syllabus. Okay. I got distracted at the past exams. Alright, readings, syllabus, recordings. Damn. Does he have every single recording?
This is BUFN 726. We're in week 5A. Actually, it says 4B here, but it's 5A. Today's February 22nd, 2023. This because interest rates had been rather high for a long time. I mean, for decades. And the perhaps you can debate about why that was the case. But with General Motors, over the benefits that are going to be paid, as well as the wages that your workers are going to get.
Okay. Does he have week 1B then?
Okay, this is institutional asset management. Okay, this is people's savings for their retirement have been wiped out, and therefore the government should provide a kind of insurance mechanism to pay their retirement. I think that's a maybe 90% bogus argument, because many of the people had not saved for their retirement at all, and those who had, the less sophisticated ones for sure, had probably saved in cash. And cash had actually gone up in value, had very high returns during the Great Depression. So I think the correct answer to the question was, you're in the middle of a Great Depression, and people who had been saving for their retirement found themselves unemployed. And so they used their savings that they had designated for retirement in their mind to support themselves during a period of extreme unemployment, and that's what ran down their savings. At any rate, you got the Social Security system and started in the 1930s, and go into higher incomes. fluctuates too much in the short run. So it might go up 50% with exposure to all the different risks in the S&P, and you're putting your money into the stock market at this very high price. The most they bought were a couple $100 million worth of stock. Okay, but that's a tiny fraction of what it would have taken to prevent the flash crash from happening in 2010. And so market makers, they do a lot of trading, and maybe they're contrarians or maybe they aren't, that's a big debate. But they typically don't hold the inventories very long, and so they typically don't accumulate inventories that are gigantic. That's kind of my area of research. I'd say that's generally the right way to think about market makers. So then, who is taking the other side of these big bets? And my answer is it's probably some kind of professional investors, and to some extent it might be the target date retirement funds, because we already said they trade in a contrarian manner. So if individual investors are trading as momentum traders, the other side of that might be the target date funds who are trading as contrarian investors. Somebody's got to be doing the opposite, because the market has to have just as many buyers as sellers when you measure it in dollars, right? Or it might be the case that there's not enough of the stabilizing trading coming from the target date funds and from whatever other institutions are trying to stabilize the market. If there's not enough, you're going to have more excess volatility and mean reversion than you had when Shiller studied it over a 100-year period that went from, I think, the 1800s and some late 1800s up until around 1980. Where he documented this excess volatility and mean reversion. So it seems like it's still with us, and it might even be as large as it's ever been. It might even be greater than it's ever been. Some defined benefit plan managers will change their asset allocations as well. How much debt, how much equity do they want to own? When the market has really gone up a lot, they may be contrarian investors who reduce their equity allocation as well. They may be rebalancing in the sense of trying to get the percentage down to some target amount, or they may even strategically be trying to forecast returns. Okay. So the question, when you put questions 4 and 5 together, there's a question of, do the people who trade ETFs behave differently from the people who trade mutual funds, or people who invest in mutual funds? So I was thinking about assets moving out of defined benefit plans into defined contribution. Some of those defined contribution investments go into ETFs, and some of them go into mutual funds. They're both mutual, ETFs are mutual funds. So why would someone invest in an ETF rather than a mutual fund? We already answered that question. It's because they probably want to trade it, and they want to trade it intraday, not at the close. So.
Shift from thinking about this. Okay. Would think that when that investors might choose to invest ETFs over mutual funds is so they could actively trade intraday, meaning within the day, within a single trading day. Actively trade, unlike a mutual fund that wire broker or would require us to get in or gets out. Or with a specified period. I wonder if there is some type of metaphor for this. I'm thinking in terms of transportation, ETFs might be kind of like driving a car. You can go anywhere you want, whenever you want. But let's say a mutual fund is kind of like taking the airplane. You have these set times and destinations that you can go to with your mutual fund. And so in the case of how does it relate to ETFs and mutual funds, when you're driving, you can go anywhere at any time. You can trade your ETF at any time on any exchange, versus with a mutual fund, you pretty much have to go directly to the mutual fund provider. So you can go to a single destination, and you can only get in or get out of the fund itself within a specified time period at net asset value. To steal it.
What does that mean for thinking about the stability of the stock market, or thinking about the returns process that is you expect to come out of millions of investors all participating in the market at the same time, or at least in the same year, some buying, some selling, and the result is the volatility that we see. Does it matter whether it's mutual fund investors or ETF investors? Yeah.
Because, like you said, the demand is for short-term investment, right? I think that's reason it's high frequency, then will be what
Okay, and I think you're getting at something. It's like people trade ETFs, people buy ETFs because they want to trade them. Maybe they want to just manage them for taxes, but a lot of times they want to actively be participating in the market, trying to make smart trading decisions. I've made the claim that retail investors often behave as momentum traders. So my way of thinking is, when I see lots of traders going into ETFs and not mutual funds, it's probably indicative of a lot of momentum trading going into the ETFs, but not necessarily. I may be wrong. Maybe these individuals are going to be contrarian types of investors. So it's not 100% clear what the effects are, but it's possibly the case that investors who invest in mutual funds tend to be more passive, so they're not tending to trade it. They're tending to invest in retirement accounts, and they're tending to do what I did, just bought that fund and kept it there for 40 years or something. So it's not totally clear what the answer is here, but I do think that there's a possibility. There's a theory that would say that active trading of ETFs, especially if it's a lot of momentum traders, is going to amplify volatility. But active trading of ETFs, if it's contrarian trading, might de-amplify volatility. So it's not totally clear what is going to happen when you put it all together. Okay, That's all I have to say about Vanguard. I was going to talk a little bit today about the introduction that I got to slide 1 of last time, but I'll postpone that until whenever. Does anybody have any questions about this Vanguard case that maybe I didn't cover, or any questions about the course that I haven't?
Okay, interesting. So with that in mind, ETFs might, with that in mind, so with that, let's destabilize turns, individual stocks, and market. Because they are actively traded. With that, ETFs might destabilize returns on because they can be actively traded, and which could lead to higher volatility. Could lead to higher volatility. Okay. Oh, actively. So I think that investors moving from actively managed funds to passively managed funds seeks to reduce fees, trading volume, and even volatility. A passively managed fund, the returns could stabilize with less volatility because there is little to no active risk that comes with trading different trading securities in an effort to beat the market. Less passive funds because the returns mimic some type of index. Okay. I think this is pretty good. Okay. Stabilizer. So how close do So Vanguard's target date retirement fund were all fund of funds, allocating different percentages to equity, bond, and money market funds with a passive approach. So 3A. From Exhibit 3A to 3B, the Vanguard lifecycle funds were able to match. She kicked out about 24 years using that well funds. Yo, what's good, Josh? There's an asset 101 shift into the Vanguard lifecycle funds. Occasionally had an extra 2 to 3% allocation away from equities every 5 years. Extra 2 to 3% allocation away from equities every 5 years. There isn't an absolute shift. Fidelity's freedom funds. Fund of funds. So these were passive. We're also a fund of funds. Also had a more active approach to investing. For about 20 years. And the pace starts to pick up. 2005. Fidelity's funds are more on pace with 100 minus age old. Because the allocation towards equities has shifted from 90%. Okay. There, like stocks. Price ever deviate from the interest. Okay. Tools. 857. Yeah, it's a lot. Okay. or no load, meaning that there was no sales commissions, buying and selling stock. Helped reduce fees. Average expense ratios. Issues low was in 2006. Exhibit 3C. 3C to 4C. Longer data lifecycle funds. So longer data lifecycle funds have higher betas compared to short. Higher beta. These longer data lifecycle funds are targeted towards younger investors. So you have human wealth. Higher allocation. So through higher betas, have long-term returns are over. Older investors have less use, so a higher beta is less desired. Don't have the ability to, okay. The shorter data don't have. They also limit the ability to generate substantial alpha due to fixed nature. Limit the ability to generate substantial alpha due to fixed natures. I see. So, let's see. We're at count 750. That's probably good enough.
Ryan, is that your stuff in the washer?
Yeah.
Okay, when it's done, my stuff is sitting on the washer. Could you just like plop it in?
Wait, what's up?
My stuff's on the washer.
Oh, yeah, I
So
got
I'm
you.
opening it. It's like I don't want it in my room. It's like hazardous.
Damn, okay. Exchange traded funds. They are trading exchange. Trade out like stocks on an exchange. Okay. Both tracks that. SP 500, but the way there for the Vanguard. It's very similar to an index fund. The investor buys it, but the way that investor buys it is different. Okay. The ease of buying and selling is really ETFs provide a very liquid way for investors to ETFs provide a very liquid way for investors to long or short a specific index. Became very popular because they are a very liquid specific index. Okay, yeah. Very liquid way for investors to long or short a specific index. To go long. With a passively managed fund, the returns get stabilized with less volatility because there is little to no active risk in passive funds. Okay. I would think that investors might choose ETFs.
I'm gonna be on the phone, so you cool then you shut your door so you don't have to.
Yeah, that's good. Okay, choose one that would require us to get in or get out. At the end of the day, where's to get us to get in or to get. With that, ETFs might destabilize returns on individual stocks. With that, ETFs might destabilize returns on individual stocks in the market portfolio. Here's stats. ETFs might destabilize returns on individual stocks in the market portfolio. ETFs might stabilize returns on individual stocks in the market portfolio. Actively traded, which could lead to higher. We trade with high volatility. So do ETFs mimic ETFs deviates from underlying index? Seems like they do, okay. Right, so what happens when we buy an ETF? So ETF prices can deviate from the actual underlying index. For someone who has a very There's some provisions for someone who has a very large block of shares, usually tens of millions of dollars worth, to demand that the shares be exchanged for shares.
It's not like who's doing their job. First of all, they're firefighters now. Second of all, no one wants to be with a drunk person because that shit sucks. No one wants to do that. That's a lot of what I'm gonna do. I know. In a city, I know.
Learning measures in transparency, liquidity.
But they're very helpful. They were very helpful. They always like were like, hey, just want to do it.
Origins. So the creation and redemption process is a unique feature of exchange traded funds that helps keeps the market price of ETF closest to asset value. I see. So this process involves authorized participants, typically large institutional investors or market makers, that facilitate the buying and selling of ETF shares on the secondary market, playing a crucial role in maintaining the efficiency and liquidity of ETFs. Right, so yeah, this is something to think about, but I think right now, in terms of the write-up, it's pretty good. I think I can probably submit this soon. Although I feel like I need to kind of shorten this a little bit, just because I think he wants this to be around 700 words. I have 776. It's 32%. Shift away from equities. Okay. Okay, you know, I think this is pretty good actually. So I'm going to probably turn this in. So Brian Zing, BMGT 726 writes up week 1B. Okay. Source Vanguard HBS case. Here, let me actually download this. Okay. Oh wait, this is definitely not it. Optional readings, the Vanguard group. Ariel. Levin. Black. None. Okay. Okay. So I have that. Let's see assignments. Downloads. Okay. So I think that's good. Oh wait. Okay. So what did it say about high PE ratios? Okay, I'll look into that at the end. But yeah, I just submitted this write up. Okay, yeah, that's nice. And then I think we have another write up. Week 2A. Oh, this isn't really that long, to be honest. There's only 7 weeks of this class. Okay. Yes, I don't really have that much time in this class, actually. Alright. Should probably start the extra credit stuff soon, though. Final exam, 40%. Wow. Okay, so we have to do the extra credit questions for. AIG value missing carry trades. Oh, credit default swaps. Okay. So insurance on credit defaults.
There's a difference between a bad faith prediction and like actually occurs.
Wow. Okay. So I think that's good.
Or you say before. Yeah. I didn't tell me the Chiefs are still crazy.
Okay.
Everton, you know what the real problem is here, right? Carl, you know the real problem is that Zach can support a football team for what they never did with the Super Bowl. He's gonna be the first person 100%. Oh my. What? Do something. What?
Exploitation of price discrepancies within fixed income markets. Swenson that said that her strategy places excessive focus on risk.
I'm okay with not supporting the other.
Believe that's Swenson.
Terry's better than that. Oh, look at him. Look, that was Mahoney-ish. That was Mahoney-ish.
So sources. Yeah, I mean, maybe I should do this in Quarto. Alright, let's open folder. We can go into okay, so let's go into desktop. New folder. FGT 726. Okay. Then I'll do. Okay, so we'll call this week 1B QMD. Oh, shit. So 9. So how would David Swenson define the efficient markets hypothesis? David Swenson was heavily invested in. Swen. Swinson would, the way I learned about the efficient market hypothesis at CMD is that markets are prices in financial markets fully represents all of the public information today. Efficient. Making it impossible to make excess return. All available. I think David Swinson would agree with this to some extent, but he would make the argument that not all markets have the same level of information to different players. Private equity. Different participants. Okay. So the way I learn about efficient market hypothesis at UMD is prices in the financial markets fully represent all information available today, making it impossible to make an excess return. To some extent, but he would make the argument that not all markets, like private equity, have the same level of information available to different participants. So I think that's the idea. I still do think that David Swinson thinks that some markets, specifically fixed income, especially the government fixed income market for US Treasuries, is super efficient. There really is no price discrepancy or excess return you can generate. But there are some markets, like the private equity market, maybe even the hedge fund world, where they have access to some private information or to some exclusive information that not all other investors have. And these people can really gain excess returns on those markets. Swinson and his team do have views on what the direction of Swinson and his team do have views on what the direction of the economy is going to. But his team do have views on the direction of the economy. But that influences their views, influence their asset allocation decisions, and doesn't influence their decision to make short-term trades or investments within a specific asset class. Private equity market is illiquid compared to public equities, making market timing difficult. Okay. So how it said something along the lines of that Yale would prefer to invest with managers than regional specialists that can build strong networks because they are like regional specialists. Okay, so choose to invest in a fund management. Bad spot. TDL.
Pull in!
Like other investors are.
Oh my god. I wanted them to clear.
Okay.
More
Seven resume poor relationships with
This formation sucks, by the way. This formation is complete shit.
currently disliked. If there were 2 to 3 instead of 20 to 30 people, then the investment was yeah, let's go first. Up there. Okay. Did Yale get into trouble during the financial crisis? I guess we don't really need to. Okay. So
Can we never use this formation again? Thank you.
it's substantial liquidity to keep its operation going. Okay.
That's really disgusting. 5-2-2-1. Yeah, Carter goes, we should try a new one. We're gonna play off.
Okay, so Yale didn't get into too much trouble during the financial crisis. It had separately managed accounts that were shielded from so the separate managed accounts helped Yale shield its investments from other investors who would take out their money from, let's say, a master fund. Other investors pulling their money from hedge from funds which caused large sell-offs to meet the which caused large sell-offs to meet deep discounts. Shielded. I feel like this is not shielded. There we go.
I just took the most gobbledygook touch of all time. Oh, that's. Yeah. This smells like a video.
Okay.
Steven, can you be Aaron? Shut up. Shut up. You know that. Fuck it. Left it long and home. Okay. Okay, I just watched Batman. Okay, Steve. I'm taking control. This is our real. We're starting this is our real. Not her.
Money in funds which cause large sell-offs. These funds should compensate. Okay, so Yale didn't get much trouble during the financial crisis. It had separately managed accounts that were shielded from other investors, pulling their money from funds which caused large sell-offs at deep discounts. Okay. So Yale's AAA credit rating helped it secure funding via commercial paper facilities and line of credit and revolving lines of credits.
Why didn't you just switch to the 4? Carter, you should have just waited
Okay.
for 4-3-3 and put his at the end.
To cover any short-term expenses. To compensate his employees, Hash.
Why the fuck would Rory even play this formation? Don't you say anything.
Think.
I'm gonna kill myself. I'm actually gonna
Hmm.
This is crazy. I'm so, you know how mad I am right now?
So, I think that the goal of the endowment is to grow the assets as much as possible. Portion of their compensation should come from the a percentage of portion of the compensation should come from a percentage of the assets within or focus on the salary, and the other portion come as bonus for positive returns. I think this is fair for both Swenson and his employees. Oops. 8:03. That the very best venture capital firms do much better than anyone else. They have superior connections and talent that returns them to. Okay, I think if we delete that, let's see. Let's see. Tools word count. Okay, that took off 50. So I need to kind of downsize this just a little bit. Yeah, this one's probably too much. Small endowments don't have access to forms of borrowing. Okay. 7:15. Oh my god. Okay. I just need to delete a few more words and then I'm good to go. Liquidity risk. Let's see. Within the public equities. Bonds. Public equities and bonds. Okay. I think this should take us to around 700. Let's go. All right. Think this is good then. Oh, didn't even have that. Okay. So I think we could do title. Brian saying week to a write-up. Okay. I think this is alternative assets and university endowments. All right. Okay. Specific asset class. Okay, so discounts. Okay, this is also part of that. I think this is also part of that as well. Sources. Sabrina. Assumption said that strategy, please.
AJ Grego was a Steelers fan, and the year the Steelers went to the Super Bowl, before they went to the playoffs, he wore a jersey that the jersey cool. Is that picture? That was it. Very modest reason for being teams. That's it. I cried when Tim Tebow scored, when Demarius Thomas scored. I cried. I cried.
Okay, I think this should be good. Cat all of Quarto Ren preview.
I'm still traumatized to some extent.
Quarto Render. Week 1B document. Let's see. Go live.
Antonio Brown tweeted, "I miss that cracker," and sent a picture of Ben Roethlisberger. I really like. I hope John is happy, but I want the Lions to win. I want the Lions to win. Okay, no, what are you talking about? I just said I want them to win. You're like, are you just counting them?
Okay.
Imagine having a Baltimore Detroit Super Bowl. That's just a safety hazard.
HTML. Alright, let's see. Nice.
You want the hood over your Dallas Cowboys here. How does that work?
Okay, let's see. What if I save page as PDF? Alright. Export as PDF. Write up. Beezing. Okay. Desktop. BMGT. Okay. Oh, this is week 2A. Shit. Alright. Wait a minute. Where is BMGT 726? There we go.
If you're a Heat fan, you support one of the worst. If you're a Heat fan, you support the maybe the worst franchise in the history of American sports. The Miami disgusting, terrible franchise. I wish you know.
Oh, nice. Okay. It's not bad. Alright, let's turn this in. Alright, that means we finished week 2A and week 1B right up. I think this is pretty good. Now I have my sources.
Even in the mid 2000s, we had years where it was. I think for like a 4 or 5 year stretch, it was miss.
Oh, okay. All right. Feels good. So was able to get. Oh man, I don't think it ended up recording. Okay, I'm gonna stop the stream now and then maybe restart the stream again because I think it screwed up on. Oh man, yeah. I think the screen share kind of got screwed up here. Yeah, I think it did. Oh shoot. Okay. Oh well, but just turned in my 2 write-ups I've been working on for this week. I think if I have some time, I might spend some time working on the extra credit because I think in order to get an A in this class, you have to work on some of the extra credit stuff. So I'm gonna need to do that. And let me put this just finished with the write-ups. Okay. Alright, yeah, I think I'm gonna stop the stream and then come back and review some concepts from the pre-class quiz that we had for my class. Because there's some stuff I still don't fully understand, so I need to do that. And then not too sure what to do after, so we'll see. Oh, go for a run, get some dinner, and staying fun and then research. Okay, I'm gonna be back in a sec.